Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, May the 21st. I'm Eric Wilkinson, and you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic, the geopolitical environments, how that's going to impact our overall markets, and that analysis thereof. Also, in these daily market commentaries, I do the same thing, but I layer on top of it some option strategies that I find, given that assumption we come up with around the market analysis based on the economic and geopolitical environments. Well, without further ado, let's get on with the economic data and see how that's impacting the overall markets today. Okay, across the pond, today actually being a pretty busy day, we've got PMI, which is Purchasing Managers Index. This is one of my favorite numbers. Why? Because it is forward-looking. These purchasing managers are buying materials in order to implement into the manufacturing sector, and the service guys are looking how the overall economy going forward is, and based on that, what their forward guidance is. So forward-looking economic data points are much better than hindsight ones, like the unemployment claims and things of that nature. Those are things that have already happened. What we want to see is what is the future holding for us, especially in a time like this with the pandemic. All of those old economic data points really don't mean a whole lot right now, right? It's all about what we are looking for in the future right now. So PMI, Purchasing Managers Index. Across the pond, we get the flash manufacturing. That's their most important economic data point. Here in the United States, we get the ISM. That's the Institute for Supply Management. Anything above 50 is expansion. Anything below 50 is contraction. What do you think we're getting right now? Yeah, we're all below 50 right now. It is just right now trying to see if they are a little bit better than what we were expecting. And pretty much they were. So let's get on with that. Flash Services PMI coming in at 29.4, expected to be 24.9, better than expected. The manufacturing out of France came in at 40.3, expected to be 36.0. Now remember, France and Germany are the biggest manufacturing sectors in the European region, so those are the ones that kind of get pulled out of the broader number. And we got German flash manufacturing coming in at 36.8, expected to be 39.3. So that is one that kind of missed really across the board. The services manufacturing or services PMI out of Germany came in at 31.4, expected to be 26.3. Manufacturing for the broader European region came in at 39.5, expected to be 38. Also, the services manufacturing for Great Britain came in at 27.8. We got the United States economic data point on the manufacturing PMI coming out of the ISM, and that came in. Actually, it wasn't our ISM, sorry, it was our flash manufacturing PMI. Came in at 39.8. Remember, we are looking for our ISM number to be the real number, but we still get our flash data point. Philly Fed Manufacturing Index came in at 43.1, expected to be 40. We also got ADP non-farm payrolls that came in at a drawdown for Canada of 226,000 people filing for non-farm payroll there. Natural gas storages should be coming out here. I thought we got, 81 billion cubic feet, expected to be 83 billion cubic feet. Also, we got the LEI, which came in at, which is the leading economic indicator, came in at negative 4.4. Well, that's not looking too good, but it was expected to be a negative 5.5, so that was better than expected there. Also, we got our flash services PMI coming in at 36.9, expected to be 32.3. We've got existing home sales. They came in at 4.33 million, expected to be 4.31 million. Something to note there, we did see prices for existing home sales increase. you would think that they might start decreasing a little bit with a lot of this unemployment that's going on, but there is a very limited supply. As a matter of fact, we saw a lot of people pulling their houses off of the markets during this whole pandemic. Another thing to note is that sales for condos is like plummeting. And that has to do with a lot of people probably wanting to get out of the city and into the suburbs, maybe away from those densely populated areas, because they're worried about these types of viruses spreading in these densely populated areas. So keep that in mind as a trend going forward, that people may not want to be living in a condo society and wanting to purchase some of these homes. So that could be driving those markets higher. As a matter of fact, that's what we're really seeing is home sales price, or the average home sale price is rocketing higher. All right, so let's talk about the overall markets based on that economic data. Well, it's kind of throwing a wet blanket on the equities, and we're heading into an extended weekend here in the United States with Memorial Day coming up. So there's probably a little bit of trepidation on holding some of these stocks going into this long extended weekend. People expected to be gathering as we're lifting some of these lockdown in and around the different states. Well, that's probably going to cause people to go out and go to parties and stuff like that, where they're going to be commingling in larger groups, which we could start to see these numbers spike based on that. So we've got crude oil moving a little bit higher today, but it does feel like a lot of these markets are feeling a little bit toppy right now. And I think that crude oil, despite the fact that we've gotten back into this value area where 70% of the time and volume has been spent, it usually means when we get too far below that, it is overextended to one side or the other. To me, this is a bit of a conundrum because there is very limited supply. We are seeing the manufacturing sector start to pick up a little bit, but there's still not a whole lot of demand based on that supply glut that we have. Yes, we are slowing down the supply, but we are seeing this glut continue. All right, we've got gold futures coming off by about $28 today. Back into in and around that area. I believe it's going to want to hang out is right in between basically the two Fibonacci's I have up here, 1658 to 1787. That's kind of the sweet spot for it. It being right here in the middle. I believe we're going to build up some volume in and around that area for the foreseeable future. Weaker dollar and the unknown could drive it higher, but I think that it gets too toppy up there above 1750-ish. That's where it starts really feeling a little toppy there, and where people want to start covering on their positions. All right, bonds making a move back into the 180 handle. As you can see, we got it in by a tick right now, back above that 50-day moving average we talked about, that we kind of settled below that. That signals long-term bearishness. Well, yesterday the market was able to climb back above that, and today we are seeing extended moves to the upside. Again, the market is going to want to stay in that 180 handle. That is the sweet spot. We start seeing a lot of support coming in here at the 178 handle. That's because we are looking at extended period of time here where we're going to see lower rates, and that's priced in with the futures here. So bonds back up into that 180 handle, which I've been talking about, I think is the sweet spot. Anytime it gets overextended there, that's the time to sell. Anytime it gets oversold there, we're going to see even the government coming in to support that level. All right, VIX is starting to move higher as the equities fell out of bed really pretty much on our economic data. They tried to rally on the overseas flash PMI numbers, but starting to see some weakness going on. So the market's been all over the place, to be quite honest, as of today. Watching the P&L just move back and forth, positive to negative on the day here. Anyway, we've got the Dow Jones Industrial Average off by about 31 points. You know, they were off by about 100 plus points earlier this morning, and even into positive territory. So really mixed bag on whenever you're taking a snapshot. NASDAQ, though, has been one of the leaders and pretty much staying in negative territory for the better part of the day. There was a brief moment where overnight we were seeing some positive green on the NASDAQ, but it has had the biggest run, so it's not really a surprise to see some profit taking going on at these levels in the NASDAQ. E-mini S&Ps off by about 16 points. They barely got into positive territory earlier today, but it is in that area that I've talked about between 3,000 in the E-mini S&Ps gets a little bit overextended. You know, we are talking less than 10% away from the yearly high, so that all culminating, it's going to want to stay in and around this area here. I don't really see a massive sell-off coming right now, but 2,900 to basically 3,000 is where I think we're going to start seeing this market really trade sideways. You can see where we briefly got into positive territory, and that was right on the open, but then we started getting our economic data in the form of existing home sales, and yes, the existing home sales was a little bit better than expected, but we were talking about inventory, the prices going up, and people pulling houses off of the market. So, and we also got our flash PMI numbers, which were in line with expectations, but with the revision, it just really did not make that number look that great. All right, so E-mini S&Ps trying to make a bit of a move back. It feels kind of like an inside day from yesterday, but we are seeing a wider range for sure going on. I haven't done anything with my portfolio right now. I am looking at a couple of things. IWM is one of those trades where I put on the broken wing butterfly last week. We got a big gap. That's one thing we don't really want to see with an iron wing butterfly, broken wing butterfly. I was expecting us to maybe trend a little bit here sideways, but we got that huge gap up, and that trade is not working out at this point. We are right at my break even on this trade. So going into the weekend, if we start seeing a bit of a correction, that may be the time to get out of this trade. But any more of a move higher, if we get much more vertical incline in this IWM, I'm going to be pulling the ripcord on this trade and getting out, because I kind of expected it being a very diverse index that the levers and pulleys on that would kind of counteract one another, and it's not really doing that. So that's something that I'm going to, it's breaking my fundamental analysis on that. So I'm going to look to possibly cover that relatively soon. I'm going to have a really itchy trigger finger on that one. And that's all I've got. I don't have a working order in that, but keep in mind, all of this stuff I'm talking about is not a recommendation for you guys to implement this into your portfolio. I am talking about things that work with my portfolio, and we try to learn on that and layer on some strategies that will work with the things that I have in my portfolio. It's up to you to decide whether or not this fits your risk parameters and or your portfolio. All right, so please take a moment to go over this, and remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, check out today's webinar. It is on the broken wing put butterfly. So we'll talk about all of the things that need to go into that strategy. We're going to talk about the strike location, the implied volatility, the duration, all of those things, and I'll break that down into finite ideas that you will be able to remember how to build this strategy out appropriately and implement it possibly into your portfolio. All right, so check that out, and if you can't take that, take it easy.